Every single day, not once a week, not occasionally, every single day, thousands of properties across this country sell for 40, 50, sometimes 70% below their actual market value. And the people buying them? They're not hedge funds. They're not billionaires with insider connections. A lot of them are regular people. Teachers, engineers, guys working 9 to 5s, who just learned something that most people never do. Here's what nobody tells you. The real estate market has a hidden layer. There's the market everyone sees, Zillow, Redfin, your local realtor. And then there's this market, the one where a $300,000 house sells for $160,000, where a landlord picks up a rental property for less than the cost of a used car, where a first-time investor turns a distressed property into a cash-flowing asset in under 6 months. These deals exist because of situations, not because of luck. Foreclosures, unpaid taxes, estates left behind after someone passes, banks holding properties they never wanted to own in the first place. And because most people don't know how to find them, don't know how to buy them, the people who do know walk away with deals that look almost unreal. Today, we're pulling back the curtain on all of it. By the end of this video, you'll know exactly what distressed properties are, why they sell for so little, where to find them, and how everyday investors are using them to build serious wealth, starting with very little. Let's get into it. If you've never heard the term distressed property before, don't worry. That's exactly why we made this video. We're starting from zero and building up. Here's what we're covering today. First, we're going to break down what a distressed property actually is and why they exist in the first place. Then we're going to walk through the 4 main types you need to know: foreclosures, tax lien properties, probate sales, and properties. After that, we're going to show you exactly how investors find these deals, because that's the piece most people never figure out. And finally, we're going to be real with you about the risks, because this is not a get-rich-quick story. It's a get-rich-smart one. If you're someone who's been watching other people build wealth through real estate and wondering how they're finding deals that you're not seeing, this is the video. If you're just starting out and you want to understand the landscape before you put a single dollar on the line, this is the video. We keep things here at Wealth Blueprint straightforward and honest. No hype, no fluff. Just the information you actually need, explained in a way that actually makes sense. Let's start at the very beginning. A distressed property is any property being sold under circumstances that force the price below market value. That's the simplest definition, and it's the one worth remembering. The key word there is circumstances. The property isn't cheap because it's worthless. It's cheap because the person or institution selling it is under pressure. Financial pressure, legal pressure, or time pressure, and they need out. Their urgency becomes your opportunity. Think about it this way. If you own a house worth $300,000 and you have all the time in the world, you list it, you wait for the right buyer, and you get close to full price. But what if you've missed 6 mortgage payments and the bank is about to take your home? What if you've inherited a property in another state and you're paying taxes and maintenance on a house you've never even visited? Suddenly, getting $200,000 fast sounds a lot better than waiting a year to get $300,000. That gap between what the seller needs and what the property is actually worth is where investors make their money. Now, how big is this market? Bigger than most people realize. According to Adam Data Solutions, one of the leading real estate data providers in the country, distressed sales, including foreclosures and short sales, have historically represented anywhere from 5 to 15% of all residential transactions in a given year, depending on economic conditions. During the 2008 financial crisis, that number climbed above 30%. Even in stable markets, we're talking about hundreds of thousands of transactions annually. And here's something that surprises a lot of beginners. Many distressed properties are not in bad shape. Some are perfectly livable homes where the owners simply hit a financial wall. The distress is in the situation, not always in the structure. That said, some are in rough condition, and that affects your strategy. But we'll get to that. First, let's break down the 4 types you actually need to know. Not all distressed properties are the same. There are 4 main categories, and each one works a little differently. Here's what you need to understand about each. Number one, foreclosures. This is probably the one you've heard of. A foreclosure happens when a homeowner stops making mortgage payments and the lender, usually a bank, begins the legal process of taking the property back. Depending on the state, this process can take anywhere from a few months to over 2 years. At some point during that process, the property goes to a public auction, often called a foreclosure sale or trustee sale. These auctions are where investors can buy properties, sometimes well below market. But they come with a catch. In most cases, you're buying the property as is, sight unseen, and you need to pay in cash, same day. High risk, high reward. Number two, tax lien and tax deed properties. Every homeowner owes property taxes. When someone stops paying them, the local government doesn't just wait patiently. Eventually, the timeline varies by state. The government places a lien on the property. In some states, they'll then sell that lien to investors who earn interest, sometimes 8, 12, even 18% annually, while the owner has a redemption period to pay up. If the owner never pays, the investor can eventually claim the property. In other states, the government skips straight to selling the deed outright at auction. This category is one of the most overlooked entry points in real estate investing, especially for people starting with limited capital. Number three, probate sales. When someone dies and leaves behind real estate, that property has to go through a legal process called probate before it can be sold or transferred. This process can take months. Meanwhile, the heirs, who may live in a different state, may be grieving, may be dealing with family disagreements, are often motivated to sell quickly and move on. They're not trying to maximize profit. They just want it done. That creates real opportunity for buyers who can offer speed and simplicity. These deals often happen off-market through direct conversations, which means less competition. Number four, REO properties. REO stands for real estate owned, meaning the bank owns it. This happens when a foreclosure auction doesn't produce a buyer and the property reverts to the lender. Banks are not in the business of owning homes. They don't want to manage them, maintain them, or hold them on their books, so they're motivated sellers. REO properties are typically listed through real estate agents or the bank's own asset management team, and while they don't always offer the deepest discounts, they're generally more accessible for beginners. No auction drama, a cleaner title process, and more time to do your due diligence. 4 types, 4 different strategies, and each one is a legitimate door into this market. This is the question everyone asks, and it's the piece most videos skip over. Knowing what distressed properties are is step 1. Knowing where to find them is where the real game begins. Start with public record and use them. Most of the information that identifies a distressed property is a matter of public record. Foreclosure filings, tax delinquencies, probate case openings, these are all recorded at the county level and are legally accessible to anyone. County recorder websites, court records databases, and tax assessor portals are free starting points. Investors who do this manually go to the courthouse, pull lists, and start calling or mailing. It's tedious, but it works, and it's essentially free. Use data platforms built for this. For investors who want to move faster, there are platforms specifically designed to aggregate distressed property data. PropStream, Atom, and Batch Leads are 3 well-known examples. These services compile foreclosure notices, tax delinquency lists, probate filings, and more, pulling from public records nationwide, and presented in a searchable, filterable format. Subscriptions typically run anywhere from $100 to $400 a month, which sounds like a lot until you close one deal. Drive for dollars. Yes, still, this sounds old school, and it is, but it still works. Investors literally drive through target neighborhoods looking for signs of distress. Overgrown lawns, boarded windows, mail piling up, structural neglect. When they find a property that looks abandoned or in trouble, they pull the ownership records and reach out to the owner directly. No competition, no middleman. Sometimes the owner is desperate and you're the first person to ever call. Direct mail and cold outreach. Investors compile lists of distressed property owners and send physical letters, often handwritten or designed to look personal. offering to buy the property. Response rates are low, sometimes 1 to 3%, but one response on a strong list can mean a $40,000 assignment fee or a property acquired $80,000 below market. The math works. Work with wholesalers. Wholesalers are investors who specialize in finding distressed deals and then selling their contract rights to other buyers, usually for a fee called an assignment fee, typically $5,000 to $30,000. For a beginner who doesn't want to do the sourcing themselves, connecting with local wholesalers is one of the fastest ways to start seeing real deals, real numbers, and real opportunities without doing all the legwork yourself. None of these require a real estate license. None require a special credential. They require consistency, follow-through, and a willingness to learn. We said at the start this isn't a get-rich-quick story, and we meant it. Distressed properties offer real opportunity, but they carry real risks, and any channel that doesn't tell you that is doing you a disservice. The property might need serious work. Distressed properties are sometimes vacant for years, pipes freeze, mold grows, roofs fail, electrical systems deteriorate. What looks like a $60,000 discount can evaporate fast if renovation costs run $70,000. Always, and we cannot stress this enough. Get a professional inspection before you commit, whenever you have the option to do so. At foreclosure auctions where you can't inspect beforehand, you need to factor in a wide margin for unknowns. Title issues can be a nightmare. When a property has passed through legal proceedings, liens, or estate situations, the title, the legal record of ownership, can get complicated. There can be unpaid liens from contractors, IRS tax lines, or competing claims from heirs. Always work with a title company or a real estate attorney to do a title search before closing. Title insurance exists for a reason. Use it. You need liquidity. Foreclosure auctions typically require full cash payment on the spot. Even in other situations, distressed deals often move fast, and sellers may not wait for lengthy financing processes. Many investors either use cash savings, private lenders, or hard money loans. Short-term, asset-based loans that close quickly but carry higher interest rates, typically 10 to 15% annually. The learning curve is real. Your first deal will be the hardest. You will second-guess yourself. You will encounter problems you didn't anticipate. This is normal. The investors who succeed in this space are the ones who treat their first deal as tuition, not a lottery ticket. Know the risks, do the homework, then move forward with confidence. Here's what we covered today. Distressed properties are real estate being sold under pressure, and that pressure creates pricing gaps that everyday investors use to build real wealth. There are 4 types you need to know: foreclosures, tax lien, and tax deed properties, probate sales, and REO properties. Finding them requires a combination of public records, data tools, direct outreach, and networking. And buying them requires preparation, due diligence, and a clear-eyed understanding of the risks involved. This is not a secret world reserved for the wealthy or the connected. It's a world that rewards the curious, the prepared, and the consistent. If this video opened a door for you, if this is the first time distressed properties actually made sense, then we've done our job. Drop a comment below and let us know. Which type of distressed property are you most interested in learning more about? Foreclosures, tax liens, probate? We read every comment and we build content based on what you want to go deeper on. And if you found this useful, if this is the kind of real, no-nonsense information you want more of, subscribing takes 3 seconds and it keeps content like this coming. No fluff, just the blueprint. We'll see you in the next one.